Hello, I'm Tyson Romanick, Senior Portfolio Manager here at Baker Boyer. Now, I'm sure a lot of you have seen the recent market pullback we've had, and there's a lot of scary things going on in the headlines, talk of recession, unemployment going up. So I'm going to address that today in the video. So the first thing I want to address is the pullback itself. Now, on average, going back to 1980, we see a 10 to 15% market correction almost on a yearly basis. So this is completely normal. We're down about, I think, 9% from all-time high back in July. So even if we were to fall more from here, this is nothing to freak out about. You also have to look back and see that we're still up 10% year to date, which is a remarkable return in any year. So that's the first thing I wanted to address. Now, over the past 2 years, kind of leading into what's caused this pullback, the Fed's been trying to get rid of inflation, and that's been its number one priority. And so it has raised rates at an unprecedented rate. And so right now, we're sitting at 5.25%, 5.5%. And what the Fed's doing is trying to slow down the economy to get rid of inflation. We've seen inflation come down. We've talked about that in a lot of our videos. So right now, inflation has fallen all the way down to about 3%, which is good. But in doing so, it's cooled off the economy, and now we're starting to see signs that this economy has slowed down. So there's really two causes that we've seen in the last week that's caused this pullback. The first one is the jobs report. So the jobs report came out, and jobs growth is a little bit slower. The unemployment rate is gone up to 4.3%, which was a little more than people expected. But you have to look, historically, 4.3% is still historically low. So we've just gone from a super constrictive, tight labor market to a little bit less restrictive. And then the good sign with that is we haven't seen layoffs rise. So really, people aren't getting fired. It's just that people who are currently unemployed are taking a little bit longer to find jobs or employment. Now, the second thing was the actual Fed meeting itself, which was last week. Everything kind of went as expected. They didn't lower rates at all, but nobody really was expecting that. I think, the good signs from that is that, Fed Chair Powell said that, he was a little bit more dovish and opened, the kind of teed up, maybe lowering rates next time. I think what the worry was there's a little bit longer time period between this Fed meeting and next Fed meeting. And so I think people are worried about what could happen between then. But Powell said, Q2's GDP was surprisingly strong. So he's happy where things are at. But those developments has caused markets to pull back a little bit. We've also seen bond yields drop. So the 10-year Treasury is back below 4%. And that's actually a good thing for those areas that, are kind of that got hit hard during high inflation and high interest rates. So like mortgages. Mortgages have pulled back, and this is a good thing for housing. So some of those areas that have been hit hard have been seeing a little bit of relief. So in summary, the economy is finally showing some signs of slowing, which is what the Fed has been aiming for. And while this, slowdown may cause concern about a recession, we aren't seeing that yet in the data, and a soft landing is still on the table. So we will continue to monitor things and make adjustments as necessary. But with that, if you have any questions or concerns, please reach out to your Baker Boyer representative.